We've all had warning, and the Fed included has made it very clear that they can very well see these very large increases in inflation. But there's something about sticker shock. And when you see the number actually print as high as it has, and you see some of these record breaking increases, it starts to become worrisome, for market participants. And I think that that's kind of been, what's shaken the markets today is that they actually saw these figures come out. They're exceptionally large. There's a number of categories that are seeing the increase. And while I think it's fair to say that it will be temporary, and there's a real good justification for that, the question is how long is temporary? And that's making people uncomfortable.
So how many months? If we see a big sticker shock kind of number like this again in May, does the Fed have to change its dovish rhetoric already? Or how many months is it going to take?
Well, not necessarily. I think it's actually less about these sticker numbers, right? Is realized inflation 0.3, 0.4, 0.5 on a month-over-month basis or higher potentially? And it's actually about the components within inflation and the drivers for future inflation. So for the Fed to become concerned, they would need to believe that it is becoming more persistent, which would suggest that some of the stickier measures within inflation are moving higher. Owner's equivalent rent, which was quite tame today. They would need to see further gains in wage pressure. So the jobs report continues to remain really important to try to understand what's happening for driving price pressures on the labor market side. And then finally, extremely important is inflation expectations. And that's probably the number one thing that Fed officials are keeping an eye out, particularly survey measures, because what makes a temporary move in inflation permanent is if expectations are heading higher.
Shepard Smith here. Thanks for watching CNBC on YouTube.